What's up, guys? Welcome to Stock Options University. Once again, my name is Ruben, and in this video lesson, I'm going to be discussing everything about implied volatility of a stock option, also referred to as the IV rank. Now, the implied volatility or the IV rank is expressed in percentages. So for example, you'll look at the options chain and it's going to tell you that this specific stock has an implied volatility of 28% versus another stock that has an implied volatility of 80%. So what does this really mean? So let's just grab stock A and stock B. Let's say they're both trading at around $100 each. Okay, but over a period of time, stock A has only moved up or down from that $100 about $1, and stock B has moved up or down about $5. So stock B is literally just doing this, right? Whereas stock A is just doing this. So because there's more chance of that strike or that stock reaching higher highs much faster because of that volatility, that contract that you're going to purchase is going to be much more expensive. Whereas a stock that has lower volatility, where it only moves up just like this, it's going to be a much cheaper contract to buy. Now, the result of you, let's say, buying a call option on a stock that has high implied volatility means that whenever that stock starts moving up and getting closer to that strike price, your rate of return and what you're going to make from that contract getting closer to the strike price is going to be way more percent of increase than a stock with lower volatility. So I know this probably is just having your head is spinning right now, but just to put it plainly, for every cent that a stock goes up with a high volatility, you are going to make an X amount of money that is much higher for that 1 cent gain versus a stock that has low volatility that goes up a cent, and determining how much value is going to be that contract is going to be worth. So hopefully that makes sense. So if you're an aggressive trader, you want to go for the option contracts that have high volatility. Now, it's very important to understand this one point, that when you do play with high volatility option contracts, just in the same way that the stock will, that your return of investment is going to go up a lot as the stock moves up if you're doing a call. If the stock happens to go down, the contract is going to be worth much less, much quicker. So it really goes both ways. So just remember that at the end of the day, you have to decide what kind of a trader you are. Are you an aggressive trader that is willing to just, risk it a little bit more to get the biscuit? Or are you a trader that just wants to kind of be conservative and buy option contracts that have lower volatility that are still going to make you money, but they're just not going to give you as much back over a period of time versus the high volatility option contracts? So I hope that makes sense. IV rank, remember, it's important to see when it comes to your strategy. It's in terms of a percentage. So something with a low percentage, so it goes from 0 to 100. A stock option with low implied volatility, let's say at 20-25%, versus something that's like 80, 90, or 95. Your return of investment is going to be much greater with that higher volatility stock. I hope that covers that. I hope you understood. If you have any questions, just feel free to just, watch this video one more time, a couple of times, just to really make sense of it all. If not, you know where to reach us. Ask the pros, ask your questions there, and we are happy to help you guys out. Thanks so much for watching, and I'll see you in the next video.